Let's also now welcome in the new listing and the man behind it, Karan Bhagat, MD and CEO at IIFL Wealth and Asset Management. Karan, good morning. Talk to us on the demerged wealth business. Just elaborate for us, the revenue drivers. Does it still continue to be the fastest growing business within capital markets?
Essentially, I'll start off with a good big thank you for all our shareholders, employees, as well as clients who've given us incredible support for the last 10 to 11 years to get us here in the first place. From a business perspective, I think the biggest two drivers for our business remain clients as well as our relationship managers. From a client perspective, I'm happy to share that our persistency ratio with clients, essentially clients who continue to remain with us, exceeds 99% over a large period of time. Even then from a relationship manager perspective, our attrition ratios continue to be less than 2.5% to 3%. And these are the two biggest resources we have at our disposal, which allows us to grow our business at an exceeding pace. From our side, as a firm, we continue to invest on the products, platform, and research piece as we go along, so as to be able to maintain the blessed platform available with our relationship managers as well as available to our clients to make best use of our services.
Wealth management businesses across India are transitioning to the trail income method. Could you explain the new method and how that transition process has been?
So I think we were the first proponents of a big shift from an upfront model to a trail model. And actually there are two shifts which are happening. One is the revenue recognition change from upfront to trail. And that's, I think, a great and a much needed change for the industry because it aligns the incentive of the relationship managers and makes it equal across all products. Now, whether he's really offering his client a mutual fund or an alternative investment fund or a PMS, the fact that he's getting commissions on one upfront, on one as an upfront or a trail, really should not influence his decision to offer his clients that set of product. But more important than the change of revenue from upfront to trail is the effort of a lot of wealth managers led by us to transition the business from a distribution model to that of an advisory model. Some of our firms are doing it under the portfolio management guidelines, some are doing it under the RIA guidelines. Okay. In either case, the principle of being a fiduciary advisor remains the same. As an advisor, our fee essentially moves on from being a fee which we are charging the client as opposed to a fee we are earning from the manufacturer. And that by itself is extremely powerful because instead of suddenly being sitting on the opposite side of the table of the client, we are able to sit on the same side of the table with the client.
Right. Karan, good to have you on the show. In the pursuit of stable income streams, the company has also been aggressively marketing your flagship advisory platform apart from scaling up your AMC business. Tell us a little bit more about how the progress has been like and what's the kind of contribution that you see coming in going forward.
So I think broadly we're breaking up our revenues into two big segments. One, what we are calling as the ARR revenue, or in other words, the annual recurring revenue. Annual recurring revenue, as the word suggests, is essentially revenue which is a sum total of the revenue, commissions, and the net interest income we'll earn on the stock of assets we manage, which essentially means even if we do not do a single transaction, that's the pool of fees or pool of income we will essentially make without the need to do a single transaction. Ideally speaking, we would like that pool to increase as much as possible, which essentially makes our business model extremely stable and non-cyclical. Today, it would be safe to say we are already close to around about 55% of our revenues as ARR revenue. The remaining 40 to 45% of our revenues would be broadly transactional revenues, which would be a mix of revenues across all asset classes, equity, fixed income, and so on and so forth. But as time was to go by, we would focus more and more on building our ARR assets. And I think on a steady state basis, over the next couple of years, we should be in a position to have nearly 75% to 80% of our revenues coming from ARR revenues, and the remaining 20 to 30% from transaction revenues, which typically will be the ideal mix as we go ahead.
Right. Karan, given the market conditions right now, how is it that you plan to manage the volatility in capital markets and consequently the business as well? Because wealth management must be getting a little tough right now.
So I think market conditions, we've kind of seen it over the last 20 years. I think from a current market condition perspective, I think there are two things which make our business relatively less volatile. More important than our business, our client portfolio is relatively less volatile. I think we have a very strong focus on a philosophy where we essentially represent to our clients we are in the business of wealth management as opposed to a business of wealth creation. And that's very important because wealth creation, we strongly believe, for clients can only happen in the business they do as opposed to by investing money. And that has allowed us to build an extremely well-balanced asset allocation driven portfolio for our clients. And in the process of doing so, we've been able to maintain and contain the volatility on the portfolios over a longer period of time. A typical portfolio with us today would be 55-60% in fixed income, 30-odd% in equities or 35% in equities, and around about 5 to 10% in alternates. Even in a stress market situation like today, more often than not, last 12 months returns would be in the region of 4.5 to 5%. So our objective from a client money management perspective continues to be targeting a return of on a blended fixed income, equity and alternate basis put together in the region of 9 to 10% on a yearly basis. For all the money we managed over the large number of years, large number of 10 to 11 years, we would be averaging a return of close to 10% per annum. And we would like to keep the volatility as low as possible. Having said that, there obviously will be a little bit of volatility in the transaction revenues which we get on a monthly stroke quarterly basis. The reason for that obviously is the risk appetite of clients go through changes.
Okay, what's the profit growth trajectory that you're seeing for FY 2021? Do you see profits being impacted because of the current adjustment phase?
So, we've kind of gone out and kind of broken up our financials for last year. And in our first quarterly analyst call, which we had a month back, essentially indicated and given out the impact of upfront revenues moving to trail. What impact would it have on our revenues last year? So for example, our revenues last year was around about 1,067 crores. The revenue accounted for on a trail basis instead of the revenue recognition on an upfront basis last year knocks down our revenue by around about 260 crores for last year. So our revenue essentially for last year ends up being 810 crores, and our profit after tax for last year, assuming all things being equal, goes down from around about 385 crores to 210 crores for last year. So the rebased number for last year is really 210 crores of profit after tax. From here on, it's a one-time kind of adjustment because of the change in revenue recognition from upfront to trail. I think going forward, we continue to believe that we'll continue to add assets, both from an organic, inorganic, as well as a natural mark-to-market growth perspective to the extent of 25 to 30% every year. And broadly, we will be able to maintain our broad retention ratios, and with a slight improvement in our cost-to-income ratios, I think we'll be able to register a very similar growth or a slightly higher growth on our profit after tax at the revised base of 210 crores.
How has been the profitability picture looking across the different products that you offer? You know, the kind of investor interest, participation that you're seeing across various product segments as well?
So I think, as I said earlier, I think the product categories, in a sense, kind of become a little less important once we move on to an advisory mandate in terms of the revenue retentions. But from an interest perspective today, I think most clients would like to start off with at least 60, 65, 70% of their new investments on the fixed income side. Even within fixed income, nearly 85, 90% would be between AAA to sovereign. On the equity side, between 30, 35%, most clients would like to follow a systematic investment plan approach, even for the 30, 35%. And even within that, I think the allocation would be 60-65% to large cap and 30-35% to mid cap. So I think that's where the broad portfolios are kind of positioned, and unless and until we see valuations correct by a further 10-15%, I really don't see the risk appetite of clients changing dramatically on one side, or on the other side, if we get a very clearer picture on consumption and the economy picking up. At that point, clients may be willing to put in more money in equities even at current levels.
Right. Karan, but are you well capitalized for growth? What would be your fundraising plans other than, of course, the listing money that you raised for the rest of the fiscal?
No, not at all. Not at all. We have no fundraising plans. We're extremely well capitalized. We had raised $105 odd million, so 750 to 800 crores in June of last year, primarily for purposes of acquisitions. Post that, we've completed 2 acquisitions. One was a small company called Wealth Advisors in December last year, and recently we also announced the acquisition of L&T Wealth 2 to 3 weeks back. We still continue to have some gunpowder on the balance sheet for if we get any other interesting acquisition opportunities as we go along. Otherwise, also we're extremely well capitalized, and as we go along, we intend to follow a fairly aggressive dividend policy going forward on our profits every year. So all things being equal, we would like to distribute nearly 2/3 of our profits every year as dividends.
Right. You've recently also acquired L&T Financial's wealth management business as well. Can you explain the rationale of this deal? What is the growth that you think that this business would bring in?
So I think it's an excellent team. I've known the team for the last nearly 10 to 11 years. And the team itself has been in the wealth management business for nearly 2 odd decades. Within L&T, over the last 7 to 8 years, they built a good business. Assets are in the region of 23,000 odd crores. Outside of the L&T treasury also, it continues to be in the region of 13 to 15,000 crores. I think we will be able to potentially merge or leverage those assets in a potentially more productive way by putting it on our platform. And we believe a good mix of client relationships and a set of relationship managers who have deep expertise in managing clients for a long period of time, combined with a platform like ours, we should be able to leverage and make that business extremely successful.
Sure. Okay, so finally then, your AUM growth guidance for FY20 and any strategy that you're looking at and that you'd like to leave us with today.
I think the AUM guidance strategy will be in the region of 20 to 30%, which will be a combination of 3 things primarily. It will be a combination of net new money to the firm, a little bit of inorganic growth, as well as the mark-to-market growth on our existing assets. So I think these 3 things put together should lead to an AUM growth of anywhere between 20 to 30 odd percent. In terms of further growth trajectories, I think it's a market where there is a fair degree of friction in building large businesses like ours. A lot of investment today is required on the technology compliance side, and a minimum size of assets needs to be there to be able to make the businesses viable. I think we've crossed that hump, and we are well positioned to be able to increase our market share as the industry matures over the next 24 to 36 months.
All right, thanks so much for joining us this morning, Karan. Good chatting with you, and congratulations.